21.2 Measuring US GDP. In this chapter, we studied two approaches of calculating GDP, that is expenditure approach and income approach. The first expenditure approach, that is and also expenditure not in GDP. Income approach, GDP and related measure of production and income, in which we study gross national product and disposable personal income. The real GDP and nominal GDP, and calculating real GDP, and finally using the real GDP numbers, or how real GDP are helpful to the economists. US GDP is the market value of all final goods and services produced within the United States during a year. In 2013, US GDP was $16.7 trillion. The Bureau of Economic Analysis in the US Department of Commerce measures GDP by two approaches: expenditure approach, income approach. The expenditure approach measures GDP by adding together consumption expenditure C, investment I, government expenditure G, and net exports N X. The table shows the expenditure method of measuring GDP. The third column shows in 2013 GDP measured by the expenditure approach was $16,668 billion. Net exports were negative in 2014 as import exceeds exports. Imports were $2,748 billion and exports were $2,242 billion. So net exports, that is exports minus imports, were $506 billion as shown in the table. The fourth column in table shows the relative magnitude of the expenditure. Consumption expenditure is by far the largest component of total expenditure. Government expenditure is the next largest. Investment and exports are of a similar size, and net exports is the smallest component. Expenditure not in GDP. Total expenditure and GDP or GDP does not include all the things that people and businesses buy. We do not count as part of GDP. Those are spending on intermediate goods and services, used goods, financial assets. Spending on intermediate goods and services is not a part of GDP. Used goods. Expenditure on used goods is not part of GDP because these goods were part of GDP in the period in which they were produced and during which time they were new goods. For example, a 2010 automobile was part of GDP in 2010. If the car is traded on the used car market in 2014, the amount paid for the car is not part of GDP in 2014. Financial assets. When households buy financial assets such as bonds and stocks, they are making loans, not buying goods and services. The expenditure on newly produced capital goods is part of GDP, but the purchase of financial asset is not. The income approach. To measure GDP using the income approach, the Bureau of Economic Analysis uses income data collected by the Internal Revenue Service and other agencies. The BEA takes the incomes that firms pay households for the services of the factors of production they hire, wages for labor services, interest for the use of capital, rent for the use of land, and profits for entrepreneurs, and sums those incomes. The US national income and product accounts divide income into two big categories: wage income, interest, rent, and profit income. Wage income. Wage income, called compensation of employees in the national accounts, is the total payment for labor services. It includes net wages and salaries, plus fringe benefits paid by employers such as healthcare insurance, social security contributions, and pension fund contributions. Interest, rent, and profit income. Interest, rent, and profit income, called net operating surplus in the national account, is a total income earned by capital, land, and entrepreneurship. Interest income is the interest that households receive on capital. A household's capital is equal to its net worth, its assets minus its borrowing. Rent includes payments for the use of land and other rented factors of production. It includes payments for rented housing and imputed rent for owner-occupied housing. Imputed rent is an estimate of what homeowners would pay to rent the housing they own and use themselves. By including this item in the national accounts, we measure the total value of housing services, whether they're owned or rented. Profit includes the profits of corporations and the incomes of proprietors who run their own businesses. These incomes are a mixture of interest and profit. Net domestic product at factor cost. The income method of calculating GDP is also known as net domestic product at factor cost. The sum of wages, interest, rent, and profit is net domestic product at factor cost. Net domestic product at factor cost is not GDP, and we must make two further adjustments to get to GDP. One from factor cost to market prices, and another from net product to gross product. From factor cost to market price. The expenditure approach values goods and services at market prices, and the income approach values them at factor cost, that is, the cost of factors of production used to produce them. Indirect taxes and subsidies, that is, payments made by government to firms, make these two values differ. The factor costs refer to the cost of factors of production, that is, rent, wage, interest, that is, incurred by the firm in producing goods and services. The factor cost does not include the taxes that are paid to the government, since taxes are not directly involved in the production process and therefore are not part of the direct production cost. However, subsidies received are included in the factor cost, as subsidies are direct inputs into the production. Government offer incentives to producers in the form of subsidies in order to reduce production cost or the factor cost. The market price is the price that consumers will pay for the product when they purchase it from the seller, and it is made partially of the factor cost. Taxes charged by the government will be added onto the factor price because taxes are costs that increase the price. Subsidies provided will be reduced from the factor price to arrive at the market price because subsidies are already included in the factor cost and cannot be double counted when market price is calculated. Sales tax make market prices exceed factor cost, and subsidies make factor cost exceed market prices. To convert the value at factor cost to the value at market prices, we must add indirect taxes and subtract subsidies. Factor from net product to gross product. The income approach measures net product and the expenditure approach measures gross product. The difference is depreciation, which is the decrease in the value of capital that results from its use and from obsolescence. Firms' profits, which are included in the income approach, are net of depreciation. So the income approach gives a net measure. Investment, which is included in the expenditure approach, includes the purchase of capital to replace worn out or obsolete capital. So the expenditure approach gives gross measure. To the gross domestic product from the income approach, we must add depreciation to total income. Statistical discrepancy. The expenditure approach and income approach do not deliver exactly the same estimate of GDP. If the taxi driver doesn't report all his tips, they get mixed in the income approach, but they get caught in the expenditure approach when he spends his income. So the sum of expenditures might exceed the sum of incomes. But most income get reported in the Internal Revenue Service on tax returns, while many items of expenditure are not recorded and must be estimated. So the sum of incomes might exceed the sum of estimated expenditures. The discrepancy between the expenditure approach and the income approach estimates of GDP is called the statistical discrepancy, and it is calculated as the GDP expenditure total minus GDP income total. The two measures of GDP provide a check on the accuracy of the numbers. If the two are widely different, we will want to know what mistakes we have made. Have we omitted some item? Have we counted something twice? The fact that the two estimates are close gives some confidence that they are reasonably accurate. But the expenditure total is regarded as the more reliable estimate of GDP, so the discrepancy is added or subtracted from income and reconcile the two estimates. The table shows the two approaches of calculating GDP. On the right side is the expenditure approach, which is calculated, which is also the GDP at market price, which is sum of consumption expenditure, investment, government expenditure, net exports, that is C plus I plus G plus NX plus taxes paid to the government. On the left side is the income approach, also known as net domestic product at factor cost, which is the income of all the factors of production, that is wages, interest, rent, profit, also includes the subsidies given by the government. From the income approach, to arrive from gross net to gross domestic product, so we have to add taxes, subtract subsidies, and also add depreciation or the capital consumption. And finally, from the gross GDP, from the income approach, we have to also add or subtract statistical discrepancy to equalize the GDP arrived from expenditure approach and the income approach. The table summarizes the calculation of GDP using the income approach and its reconciliation with GDP using the expenditure approach. The income approach measure of GDP equals net domestic product at factor cost plus indirect taxes less subsidies plus depreciation, that is capital consumption. In 2013, GDP measured by the income approach was $16,668 billion. This amount is $154 billion more than GDP measured by the expenditure approach, a statistical discrepancy of $154 billion. Negative $154 billion. Wages are by far the largest part of the total income. GDP and related measures of production and income. Although GDP is the main measure of total production, you will sometimes encounter another concept called gross national product or GNP. Gross national product. A country's gross national product or GNP is the market value of all the final goods and services produced anywhere in the world in a given time period by the factors of production supplied by the residents of that country. For example, Nike's income from the capital that it supplies to its Vietnam shoe factory is part of US GNP but not part of US GDP. It is part of Vietnam's GDP. Similarly, Toyota's income on the capital it supplies to its Kentucky auto plant is part of US GDP but not US GNP. It is part of Japan's GNP. Pharmaceutical drugs produced in Ireland by US drug company is part of US GNP but not part of US GDP. Therefore, in GDP, where goods and services is produced matters, whereas in GNP, who produces goods and services matters. So GNP is equal to GDP plus net factor income from abroad, that is income received from or paid to other countries. The difference between US GDP and GNP is small, but in an oil-rich Middle Eastern countries such as Bahrain, where a large amount of capital is owned by foreigners, GNP is much smaller than GDP. And in a poor countries such as Bangladesh, whose people work abroad and send income home, GNP is much larger than GDP. Disposable income. Disposable personal income, which is the income received by households minus personal income taxes paid. So the disposable personal income is personal income minus personal income tax. So here it is the chart shows how disposable personal income is calculated and how it relates to GDP and GNP. GDP plus net factor income from abroad gives you GNP, and if you subtract depreciation gives you net national product, and if you subtract statistical discrepancy you get national income. If you add transfer payments by government minus profits retained by firms to national income, you'll get personal income or personal income. And if you subtract personal income tax from personal income, you get disposable personal income. This is how the disposable personal income is calculated, and it is related to GDP and GNP. Real GDP and nominal GDP. Now let's differentiate between real GDP and nominal GDP. GDP measures total expenditure on final goods and services in a given period. Suppose that we want to compare GDP in two periods, say 2009 and 2013. In 2009, GDP was $14,418 billion, and by 2013, it was $16,668 billion, a 14% higher in 2009. What does this 14% increase mean? The answer is a combination of two things. We produced more goods and services, or we paid higher prices for our goods and services. Producing more goods and services contributes to an improvement in our standard of living. Paying higher prices mean that our cost of living has increased but our standard of living has not. So it matters a great deal why GDP has increased. If the 14% increase is accounted for mainly by higher prices, our standard of living hasn't changed much. But if the 14% increase is accounted for mainly by the production of more goods and services, our standard of living might have increased a lot. Economists at the Bureau of Economic Analysis distinguish between two GDP concepts, real GDP and nominal GDP. Real GDP is the value of the final goods and services produced in a given year expressed in terms of the prices in a reference base year. The reference base year is the year we choose against which to compare all other years. In the United States today, the reference base year is 2009. Nominal GDP, which is the value of the final goods and services produced in a given year expressed in terms of the price of that same year. Nominal GDP is just a more precise name for GDP, or it is the GDP calculated for that year. Calculating real GDP. The goal of calculating real GDP is to measure the extent to which the total production has increased and remove from the nominal GDP numbers that influence the price changes. To focus on the principles and keep the numbers easy to work with, we will calculate real GDP for an economy that produces only one good in each of the GDP category, that is C, I, and G. We will ignore exports and imports by assuming that net exports is zero, that is exports minus imports. In the table, the base year is 2009, so the real GDP and nominal GDP are equal in that year. Between 2009 and 2013, the production of security services, that G, increased, but the production of t-shirts and computer chips decreased. In the same period, the price of t-shirts and computer chips, I, decreased. In the same period, the price of the t-shirts remained constant, but the other two prices doubled. Nominal GDP increased from $100 million in 2009 in Part A to $300 million in 2013 in Part B. Real GDP in Part C, which is calculated by using the quantities of 2013 in Part B and the price of 2009 in Part A, increased from $100 million in 2009 to $160 million in 2013, a 60% increase. It means nominal GDP in 2013 is 3 times its value in 2009, but real GDP in 2013 is only 1.6 times its 2009 value, a 60% increase in real GDP. Using the real GDP numbers, the most common use of real GDP is we can calculate the annual percentage change of real GDP, the annual growth rate of real GDP. By calculating real GDP every 3 months, known as quarterly real GDP, the Bureau of Economic Analysis is able to provide valuable information that is used to interpret the current state of the economy. This information is used to guide both government macroeconomic policy and business production and investment decisions.